Primary sources: Financial Times, Trading Economics, Bloomberg Markets, CNBC Markets, Brussels Morning Newspaper Analysis. Sources: J.P. Morgan Global Research Market Outlook 2026, Rabobank Global Outlook 2026, oilprice.com. Geopolitical Analysis Expert Commentary, Natasha Kaneva, J.P. Morgan Global Head of Commodities Research, Arne Lohman Rasmussen, Global Risk Management Chief Analyst, Jason Furman, Harvard economist, Market Data, Trading Economics, Real-Time Data, Bloomberg Terminal Reports, International Energy Agency Supply-Demand Forecasts. Script begins. Before we dive into today's market chaos, make sure to hit that subscribe button and give this video a like. Your support helps us bring you critical market analysis every single day. The world woke up on January 16, 2026 to a financial landscape transformed overnight. Markets across 3 continents experienced violent swings as traders scrambled to process 2 converging forces that nobody saw coming together with such brutal timing. Political uncertainty reached fever pitch just as oil prices tumbled below critical technical levels, creating a perfect storm that has portfolio managers questioning every assumption they made entering this year. Let me paint you the picture of what's actually happening right now. WTI crude oil futures are hovering around $59 per barrel after sliding more than 4% in yesterday's session alone. That's not just a number on a screen. That's the lowest level since early 2021, and it represents a fundamental shift in how global energy markets are pricing risk in an environment where geopolitical tensions should theoretically be pushing prices higher, not lower. Here's where it gets absolutely fascinating. President Trump softened his earlier threats of military action against Iran just 48 hours ago, saying he'd been assured that no further killings would occur and that executions would not proceed. Reports emerged Thursday suggesting that Israel and several Middle Eastern allies had actively asked the United States to delay any attack on Iran amid fears Iran would retaliate by striking their countries directly. These developments reduced the perceived risk of an immediate conflict that could disrupt Iranian oil production or critical shipping routes through the Strait of Hormuz. But wait, because this is where traditional market logic breaks down completely. Despite these geopolitical risks easing, despite what should be a bullish catalyst for oil demand, prices continue falling like a stone. The International Energy Agency expects supply to exceed demand by 3.85 million barrels per day in 2026. That's equal to nearly 4% of global consumption. Think about that magnitude for just a moment. We're not talking about a minor imbalance. We're talking about enough excess oil to fill every storage facility from Texas to Singapore and still have barrels left over with nowhere to go. Make sure you're subscribed because what I'm about to reveal about the supply side will shock you. Venezuela adds another layer of complexity that most analysts completely missed until it exploded across their terminals. The country produces 1.1 million barrels of crude per day, with most of it flowing to China and India, according to Rystad Energy Analysis. Although the volume represents just 1% of global trade flows, the quality is unique. More than 67% of Venezuela's output is heavy crude, a specific grade that certain refineries are configured to process and cannot easily substitute. The recent U.S. military operation that resulted in Maduro's capture has created operational chaos that's only now becoming visible in actual export flows. PDVSA, Venezuela's state oil company, has begun asking some joint ventures to cut output because crude is backing up at terminals and exports are harder to move. Storage limits, legal risk, and slower cargo clearance are forcing shut-ins across multiple fields. There is no near-term path to higher Venezuelan supply under these conditions. The possibility of U.S. troops maintaining presence on the ground adds uncertainty around ports, terminals, and entire oil field operations. Here's what the experts are missing. Amina Bakr, head of OPEC Plus and Middle East research at KP Lair, stated that the market is underestimating the impact of geopolitical risk to some extent. That's why there hasn't been a build of a large premium in prices. But she emphasized it's crucial to note this is happening at a time when the market is oversupplied, so there are far fewer concerns over the loss of some supply volumes. The stock market reaction tells an equally dramatic story. The S&P 500 rose to 6,971 points on January 16th, gaining 0.39% from the previous session. Over the past month, the index climbed 3.72%. But look beneath that surface calm and you'll find something far more turbulent. The index experienced its first back-to-back losses of the year just days ago, buffeted by industry losses and escalating geopolitical issues that refuse to stay contained. Taiwan Semiconductor delivered blockbuster results that sent shockwaves through technology markets. The company posted a 35% increase in fourth-quarter profit, crushing analyst estimates amid relentless demand for artificial intelligence chips. Even more significantly, Taiwan Semi announced plans to boost 2026 capital spending to between $52 billion and $56 billion. That's an outlook signaling profound confidence in the AI build-out from the world's largest contract chip maker. The stock jumped more than 4% on the news. Nvidia climbed 2%. Applied Materials surged 5.6%. Micron Technology added 1.1%. Broadcom gained nearly 1%. The entire semiconductor sector rallied on what RBC Capital Markets analyst Srini Pajuri described as an unprecedented surge in artificial intelligence spending from hyperscalers that should keep the sector's growth strong for the next 2 years. But here's the critical question nobody's asking loudly enough. Pause for a moment and consider this. Hit that like button if you're starting to see how these pieces connect. When Harvard economist Jason Furman calculated that U.S. GDP growth in the first half of 2025 was almost entirely driven by data center spending, he revealed something profound about the fragility of this rally. Big tech companies are hoarding high-end graphics processing units at unprecedented scale. They're spending billions on infrastructure that hasn't yet demonstrated clear paths to profitability at the application layer. OpenAI, the creator of ChatGPT, expects to burn through approximately $17 billion in cash during 2026. The company continues relying on outside capital, which may involve an initial public offering this year. If OpenAI goes public, investors will get a closer look at what many describe as questionable economics behind the generative AI industry. That could be the catalyst that pops what numerous analysts believe is a trillion-dollar bubble. Financial sector stocks provided some stability Thursday. Goldman Sachs surged 4.6% after fourth-quarter profit topped Wall Street estimates. Morgan Stanley climbed 5.8% on robust deal-making results. BlackRock hit record assets under management. These gains helped offset weakness elsewhere, but they also masked deeper concerns about credit markets, returns on AI spending, and potential turmoil with the U.S. Mexico-Canada trade agreement set to expire this year. The Federal Reserve's position adds yet another dimension of uncertainty. After several rate cuts that brought the federal funds rate to the 3.5 to 3.75% range, officials and market forecasts suggest a pause early in the year. Inflation remains above the Fed's 2% target but trends lower, supporting a cautious easing stance. At the same time, the pending transition in leadership creates additional volatility. Jerome Powell's term is ending. Potential successors are under consideration. There's clear division within the Fed on how quickly and how far to ease policy. Here's where it gets even more complex. Stay with me because this next part is crucial. President Trump's tariffs continue generating ripples through every sector. The Budget Lab at Yale calculated that tariffs raise the average tax on U.S. imports to 16.8%, the highest level since 1935. Goldman Sachs research indicates U.S. companies and consumers collectively paid 82% of the tariffs in October 2025. By July 2026, 67% of the burden will fall on consumers alone. The Institute for Supply Management reports U.S. manufacturing activity has now contracted in 9 consecutive months due to economic uncertainty created by these tariffs. That's not a blip. That's a sustained deterioration in one of the economy's most important sectors. The Supreme Court will decide this year whether the White House even had authority to enact these policies. If they rule against Trump, the U.S. could be forced to refund hundreds of billions in collected levies, potentially causing investors to fundamentally reevaluate the nation's fiscal condition. European markets reached record highs despite these American headwinds. The Pan-European Stoxx 600 climbed 0.3% shortly after the opening bell, with most sectors and major regional bourses moving upward. Brussels morning newspaper reported that European financial markets entered the new year amid notable volatility as oil drops sharply, prompting broad reassessment of risk, inflation expectations, and sector performance across the continent. Subscribe now because the geopolitical situation is about to get significantly more complicated. 4 specific flashpoints are reshaping energy risk perceptions in ways most traders haven't fully absorbed. Venezuela, as discussed, is positioned to add volatility rather than barrels. Iran's role in oil markets is becoming more unpredictable even without direct confrontation. Yemen and the Red Sea present ongoing maritime risks that insurers are pricing into every cargo that transits those waters. Somalia and the wider Horn of Africa feature contested control over ports, coastlines, and maritime access points. Eurasia Group's Top Risks 2026 report argues that the United States itself is becoming the principal source of global risk. The research notes how quickly political decisions can now translate into force, with Venezuela representing one of the first cases where markets are seeing that dynamic play out directly. For oil markets, the disruption is already operational and affecting real cargo movements and storage decisions. Turkey has added an energy dimension to its expanding footprint in the region. Ankara has begun offshore oil and gas drilling in Somali waters through state-backed entities operating under agreements that combine exploration, security cooperation, and maritime protection. This creates overlapping claims and potential flashpoints that could disrupt shipping lanes with little warning. Yemen itself isn't closing Bab el-Mandeb, the critical strait connecting the Red Sea to the Gulf of Aden. But it's making the route unreliable. Unreliability is costly. Saudi airstrikes recently targeted positions linked to the Southern Transitional Council, a UAE-backed force controlling large stretches of southern Yemen's coastline. These strikes coincided with moves by Saudi-backed government forces to push back against recent STC territorial gains. Let me show you what this means in practical terms. Pause here and really absorb this. Insurers price that uncertainty into every contract. Operators route around problematic areas where they can, adding days to voyage times and thousands of dollars to shipping costs. Freight rates and insurance premiums react to this uncertainty early, before anything is actually shut in or blocked. Small incidents, sharper rhetoric, or minor disruptions around shipping lanes start mattering more because the margin for error is thinner than it's been in decades. China's demand dynamics add another critical variable. While November 2025 imports climbed 5% year-over-year, industry executives suggested this increase reflected strategic stockpiling rather than actual consumption growth. Companies are buying and storing oil not because they need it immediately, but because they're hedging against future supply disruptions or price spikes. That behavior creates artificial support for current prices while masking underlying weakness in real demand. The International Energy Agency expects Brent crude near $55 per barrel in Q1 2026. Global supply growth of 3 million barrels per day this year and 2.4 million barrels per day next year absolutely dwarfs projected demand increases below 1 million barrels per day annually. Floating storage near 180 million barrels further illustrates the difficulty producers face in placing barrels into the market. OPEC Plus confirmed its Q1 2026 production pause following December's 137,000 barrel per day increase. The pause was intended to prevent seasonal oversupply. Instead, it signaled to traders that even modest output additions are straining market balances. The group has already unwound 2.2 million barrels per day of voluntary cuts and is scheduled to restore another 1.65 million barrels per day. This reinforces expectations that additional volumes will flood the market after Q1 expires. Make sure you're following along because these next connections are absolutely critical. The dollar's performance throughout 2025 provides important context. Fed rate cuts typically lead to a weaker dollar, but lurking underneath are deeper concerns about the central bank potentially losing independence from political agendas. Rabobank's Global Outlook 2026 expects the EUR to USD exchange rate to reach 1.18 over the next 12 months. Political pressure on the Fed and the U.S. cyclical downturn are cited as factors weighing on the dollar's medium-term trajectory. For the British pound, pressure remains intense due to political uncertainty and anticipated rate cuts by the Bank of England. Trade conflicts, populism, and dependence on critical raw materials could all trigger renewed market volatility throughout the year ahead. Global economic growth will remain moderate, with relatively low inflation and falling energy prices creating a complex environment for policymakers and investors alike. The Eurozone economy faces its own distinct challenges. Energy costs remain elevated compared to the United States and China despite currently lower oil and gas prices, fundamentally undermining industrial competitiveness. Low research and development spending weighs on productivity growth. Demographic trends featuring rapid aging and declining population growth pose existential risks to both labor supply and aggregate demand. Germany announced fiscal stimulus measures that provide some support. But the trade agreement with the United States, while offering short-term stability, remains a source of profound uncertainty. Washington could still pull the plug on arrangements, leaving European exporters scrambling to adapt to new tariff structures or market access restrictions. Let me break down what Wall Street's smartest analysts are actually saying about where we go from here. J.P. Morgan Global Research assumes growth will run at or above potential across most developed markets in 2026. They expect inflation will continue declining, albeit remaining sticky in several jurisdictions. This could create further decoupling in monetary policy outcomes. The Federal Reserve is projected to cut rates by another 50 basis points. The Bank of Japan is expected to hike by the same amount. Most other developed market central banks will likely either stay on hold or conclude their easing cycles in the first half of the year. Natasha Kanova, J.P. Morgan's global head of commodities research, addressed how imbalances in the oil market are shaping price forecasts. She emphasized that supply-side dynamics combined with uncertain demand growth from China create a challenging environment for bullish positioning. Traditional geopolitical premiums aren't materializing because the market remains fundamentally oversupplied despite regional tensions. Credit markets present their own set of concerns. J.P. Morgan expects moderately wider spreads of 110 basis points in U.S. high-grade bonds by year-end 2026. Even with this widening, high-grade bond spreads will remain quite tight by historical standards, implying a flat excess return and total return around 3%. In Europe, the credit cycle is likely to advance in an environment of cheaper funding rates and reduced policy uncertainty, with some corporates beginning to relever their balance sheets. Infrastructure spending requirements are massive. Global data center construction and European defense and infrastructure projects could require significant amounts of funding from both public and private credit markets. This creates competing demands for capital at a time when interest rate uncertainty makes long-term planning exceptionally difficult. Subscribe and hit that notification bell because what happens next week could change everything. State Street writes that regional policy shifts suggest a more supportive macro backdrop for global growth in 2026. With an inflation trajectory trending lower, U.S. policy rates likely to fall as the Fed takes stock of a softening labor market, and policy levers turning stimulative in key regions, the environment technically supports risk assets. But there's a massive caveat. Fidelity International identifies a profound disconnect between the positive short-term environment for risk assets and broader structural instability. Global fragmentation is accelerating. The dollar's depreciation creates winners and losers across trade flows. Federal Reserve independence faces unprecedented political pressure. AI capital expenditure trends remain wildly uncertain with unclear profitability timelines. NatWest describes AI as a powerful engine of economic expansion. BlackRock Investment Institute suggests the technology will likely keep trumping tariffs and traditional macro drivers for the foreseeable future. Even the most bearish firm, BCA Research, which actively warns of a potential U.S. recession, stays neutral on stocks for now precisely because of AI's huge capital expenditure tailwind. But here's what keeps risk managers awake at night. The biggest fear isn't missing exposure to this transformational technology. The biggest fear is that when sentiment eventually sours on AI economics, the correction could be swift and brutal, given how concentrated these bets have become. Consumer spending represents approximately 70% of U.S. GDP. This economy fundamentally runs on people spending money and buying things, often on credit. In the current K-shaped recovery, wealthier consumers continue spending robustly, supporting corporate earnings. But lower and middle-income households face mounting pressures from persistent inflation, higher borrowing costs, and stagnant wage growth in many sectors. Wall Street forecasts for year-end 2026 S&P 500 levels cluster around 7,500 to 8,000 points. Optimistic calls reach approximately 8,200 from firms like Oppenheimer and Deutsche Bank, reflecting expectations for mid-teens earnings growth. Current levels hover near 6,800, implying significant potential upside if those growth rates materialize. Historical patterns provide important perspective. When the S&P 500 has gained at least 15% in a year, the following year's returns have averaged about 8% according to Adam Turnquist, Chief Technical Strategist at LPL Financial. The index in those years experienced an average decline of roughly 14% at some point before rebounding and climbing higher. It's a reminder that market gains are rarely straightforward, even during bull markets. One final piece of context that matters enormously but gets insufficient attention. We're in the second year of the U.S. presidential cycle. Historically, this has been the weakest year for total returns and typically features the most significant volatility. The first and fourth years usually deliver the strongest equity market returns. Year 2 is characterized by policy uncertainty, midterm election positioning, and heightened political noise that can overwhelm fundamentals for extended periods. Paul Taylor of Mackenzie Investments examined this pattern extensively. After such a strong run in global equity markets in 2025, it would be genuinely surprising if there were no sizable market pullbacks as we progress through 2026. He emphasizes this would be normal given previous analogs and that forward returns from market lows have historically been strong. Make sure you manage the risk profile of your portfolio in a manner that aligns with your personal constraints and objectives. Expect the best. Plan for the worst. That's not pessimism. That's prudent risk management in an environment where political uncertainty and falling oil prices are creating cross-currents that even sophisticated algorithms struggle to parse. The next few weeks will be absolutely critical. China releases Q4 GDP data Monday. The Fed enters its quiet period ahead of the January 28th decision. The ECB meets just a week later with several governing council members scheduled to participate in panel discussions at the Davos Forum. Trump, Treasury Secretary Bessent, and Secretary of State Rubio's presence on the global stage suggests U.S. foreign policy will once again dominate headlines and potentially move markets. If you found this analysis valuable, smash that like button and subscribe for daily market coverage that cuts through the noise. Share this video with anyone trying to navigate these complex markets. Drop a comment below with your thoughts on whether oil continues falling or rebounds from these levels. Are you positioning for continued volatility or betting on a market stabilization? The only certainty right now is uncertainty itself. Political tensions simmer across multiple regions. Oil markets grapple with oversupply despite geopolitical risks. Equity valuations remain elevated by historical standards. AI spending continues at breakneck pace with unclear profitability timelines. Central banks navigate conflicting mandates amid political pressure. This is the market landscape of January 16, 2026. It's messy, it's complicated, it's filled with contradictions that defy simple narratives, but it's also filled with opportunities for those who do the work to understand what's really happening beneath the surface headlines. Stay informed, stay disciplined, and whatever you do, don't let short-term volatility shake you out of positions that align with your long-term investment thesis. Thanks for watching. I'll see you in the next video, where we'll dive even deeper into how these market dynamics are likely to evolve. Until then, trade safe and think critically about every headline that crosses your screen. Remember to like, subscribe, and turn on notifications. This is information you can't afford to miss.